Welcome to Market Overtime. I'm Oliver Renick. My guest today might just be one of the happiest men on Wall Street, given the price of gold at record highs. He's arguably the biggest advocate for the asset and has paired that stance with some of the most bearish views on the U.S. economic system for years, including one warning before the housing crisis in '08 that real estate prices were due for a crash. Since I've known Peter Schiff, he's told me the U.S. dollar is on a path to destruction and that gold's victory over Bitcoin is just around the corner. The chief economist and global strategist at Euro Pacific Asset Management is with me here today. Peter, thanks for taking time to chat with us some more.
Oh, Oliver, always a pleasure to be with you.
Appreciate that. How accurate was that description? Are you the happiest man on Wall Street? You taking victory laps lately?
No, not yet. I mean, I don't think it's close to total vindication, although I think I'm vindicated, but the markets haven't quite yet done what I ultimately know they're going to do. So I think at the end of the day, when the game is over, then I will declare victory. But right now, I'm just encouraging people to follow my investment advice because I'm 100% certain that I'm right.
A lot of people give you a lot of grief, Peter. You have had some of the more negative views on where the U.S. Economy is going structurally, and you've represented that view, I mean, through a lot of different things, but gold is kind of where you've built your namesake. We're up 24% in the last 6 months in gold. We're at 23.50 as we speak. So if that's not success, what more are you looking for in that particular trade?
Well, gold is going much, much higher. This is just the beginning of a massive repricing of gold. And, you know, people aren't even buying it yet. You have central banks buying, but investors aren't even buying gold. Retail investors, the institutions, they're not in the market at all. They don't even understand why gold is rising. They're attributing it to geopolitical risks, but it's all about inflation. The key is that the markets have the inflation story wrong. The Fed rate hikes up to 5.25%, 5.5%, have not been nearly enough to put the inflation genie back in the bottle. Yes, we had a small decline in the CPI. We went from a high of just over 9% to about 3%. We're now more around 3.5-ish. But that's it. We've seen the lows. We're going back up. We're going to be above 9% maybe by next year, but we're not going anywhere near. You think we get back to that? Oh, yeah, we're going to go higher than that. You know, we're not going anywhere near. You know, in 1969, when inflation spiked up to about 6.2%, then it pulled back to the mid threes in 1970, 71, and everybody thought the problem was over. And then it exploded, and within 2 years, it was double digits. And then we had the rest of the 1970s. So, yes, we've had an initial decline from a huge spike. But remember, inflation is the expansion of the money supply and the expansion of credit. And we had a major expansion of the money supply during the QE era, particularly during COVID. And even though the Fed has stopped QE, it continues to hold interest rates artificially low. The rates are still stimulative. They're not restrictive the way Powell claims because debt continues to hit new records. Consumer debt is at record highs. Household debt, credit card debt keeps making new record highs. Consumers keep borrowing money and spending it, and so does the government. Budget deficits are at record highs. There's been no cuts to government spending. And so inflation is continuing despite these rate hikes. In fact, the rate hikes are also costs that have to be, added into goods prices because interest rates are like raw materials or labor or rent. And so all this is being passed on. And so nothing has been done. In order to really fight inflation, the Fed needs to raise interest rates much higher than it's already raised them. And the government needs to cut spending. And then so do consumers. Everybody has to reduce their spending, but they're not. Now, people are buying less, but they're paying more. So they're still spending and they're taking second and third jobs. You know, moonlighting has exploded. More Americans than ever are working multiple jobs to pay the bills, but all those paychecks being spent, we're pushing up prices. So we're early in an inflationary spiral. This is going to make the 1970s, look tame by comparison, much higher inflation, especially when you consider the fact that we don't have the same CPI. The CPI back then was far more honest than the one we got now.
It's a big inflation call in there. Number one is that you think we're going to get back to recent highs, and that it's going to make the 70s look like a cakewalk. But the main, I guess, counterpoint I would offer right off the bat then, Peter, is that even if all these things you're saying are true about the job situation here in America, this kind of spiral you see the debt going on, we look around the world, and I would say that there's no one even close. The Europeans basically are forced to cut right now because their economy is in tatters, basically, and China's barely getting back to normal post-COVID. So if the U.S. still is the best house on the block, then why do these things break us down?
We're not the best house.
Who's better, Peter? Who's doing a better job than the U.S.?
Well, all the countries that have trade surpluses with us because their economies are actually producing. We're living on a mountain of debt. That's the problem. And we're that, the foundation of that is about to collapse because the world is now moving out of the dollar. They're de-dollarizing.
Well, since COVID, Peter, dollar's up. Dollar's up since COVID. Our GDP is above the pre-COVID trajectory. Our GDP post-COVID.
The GDP is phony because the deflator is not real. The government is underestimating how high inflation is. So it only looks like the economy is growing. It's inflation.
What's the big one there you think is missing, Peter? In your inflation basket, to get specific there, what's the big flaw in your mind in the way we record inflation?
We don't accurately get the price increase. Look, I did my own little study. This was years ago. So back in 2013, I looked at the CPI, and according to the government, and I made a YouTube video of it, but according to the CPI, newspaper and magazine prices were up by 30% over a 10-year period. So I actually looked back. I went back 10 years earlier, and I took like the top 20 circulated newspapers and magazines in the country, and I looked at what the prices were 10 years earlier, and then I looked at the prices that year, and the actual increase was 130%. But the government claimed it was only 30%. Now, I don't know how they did that. I don't know what goes on, in the methodology behind the CPI, but 130% price increase went in, and only a 30% price increase went out. So they have all kinds of weird adjustments that they make. Inflation is much higher. I'd say it's at least double what the CPI is. So if the government claims inflation is 2, it's 4. And when they claimed it was 9, it was probably 18. People are struggling. It's a lousy economy. People's real incomes have been eviscerated by inflation. They're forced to work multiple jobs. They're drowning in a mountain of debt. And we're headed for a major disaster. We're going to have a fiscal crisis, a currency crisis, because the Fed is going to have to choose between letting inflation run out of control or raising interest rates enough to crash the stock market, crash the housing market, cause a financial crisis, have banks fail, and not bail them out. The only way to fight inflation is not to bail out any failed banks and to force the government to cut spending. And I'm talking about Social Security, Medicare, pensions for government workers, defense. The government is going to have to make across-the-board spending cuts. And if we don't get that, we're going to keep having more inflation.
Okay, so there's one tangible outcome across-the-board spending cuts. But I'm having trouble seeing how you connect all these things, the many things you just rattled off there, Peter, when right now, as our debt has accumulated post-COVID, our GDP is more on track than anybody else. The stock market's at records. Yes, your gold is at records, but the stock market is also at records. Household financial ownership of assets is at an all-time high, so people are benefiting from that greatly. Their debt has gone up, but their jobs are still paying off the debt, Peter. So how do these things connect when it seems like post-COVID, the thing that you would describe as destructive, the printing of the money, has actually elevated us relative to the rest of the world?
It hasn't elevated us at all. We have, yes.
Relative to the rest of the world, you would argue we haven't? What nation,
let me
Peter,
answer your
is
question.
doing better than the
Look,
U.S.?
The
What
stock
nation?
market has gone. Let me answer your question. You just keep talking. The stock market has gone up because money is too easy. Credit is too easy, and investors are expecting the Fed to cut rates. And investors believe in a fantasy of a soft landing and 2% inflation. None of that is going to happen. And so when reality rears its head, the stock market's going to collapse unless the Fed just lets the inflation run, which is what I think is going to happen. And maybe the stock market doesn't crash in dollars, but it crashes in terms of gold. And when the stock market goes down, so is everybody's wages, because the price of everything is going to keep going up. And the bottom is going to drop out of the dollar because our global creditors are going to realize that we can never pay the debt and inflation is never going to stop. And the central banks that are moving into gold now, they're going to accelerate their buying. And then the price of gold will move up even faster and bonds will collapse. And, you know, the entire banking system is insolvent. That's the big problem. When interest rates were kept at zero and all these homeowners were refinancing their mortgages at 3%, the banks own all that paper. They're insolvent now. They own all these treasuries. Thanks to the government, the Fed, the entire U.S. banking system is insolvent. And if the Fed actually raised interest rates to an appropriate level, all the banks would fail, including all the too big to fail banks.
So far as they've raised interest rates, we had stress in banks. Some failed. It seems like the ones that were taking the most risk. A lot of what you're describing as insolvency is contingent on a massive blowout in rates, is it not? They're not insolvent as of today. They're insolvent if rates have a massive blowout move.
No, they are insolvent. If the Fed leaves interest rates here over the next couple of years, more banks are going to fail.
Okay, give me something we can hold on to there, Peter. What banks, how many, by when? Give me some timelines so we can see if this stuff happens.
I think all of the big banks will eventually fail if the Fed doesn't cut rates. But they have to raise rates.
By when?
And so when they raise them, I don't know. But I wouldn't keep any money in a U.S. bank. I mean, you're going to lose for sure because either the bank fails and the government prints a bunch of money and your money loses its value, or the government doesn't bail out the banks and you lose your money because the bank fails and the FDIC is broke. So either way, you're going to lose. And, you know, if the Fed hadn't made the mistake of bailing out those banks last year, we probably would have already had a financial crisis because more would have failed.
Okay.
But, you know, you now have, again, the perception of a Fed put that the Fed is not going to let any of the banks fail. And so that's kind of keeping customers from grabbing their money. But that's going to change.
There's a lot in there. Too much for me to try and parse and argue each one. Let me ask you this, Peter, because I can kind of sum it all up from a perspective of a news person or a conversationalist that you sound exactly like a Bitcoiner, but yet you are constantly in the public realm saying that their choice through this storm that you guys described, you sound exactly like Kathy Wood when I talked to her on the same program a couple months ago. What's the difference? You sound exactly like the coiners. Why do you hate them so much?
I don't sound like them. They sound like me. You see, a lot of these Bitcoiners.
I'll give you that. They kind of latched onto your whole thing.
Because, look, they're taking what I'm saying about inflation and fiat money and the economy, and now they're using that as a reason to pump their worthless Bitcoin. Because they're trying to sell the public on Bitcoin as if it was gold, some digital version of gold that's actually better than gold.
For the last 10 years, it's been beating the heck out of gold, Peter. And you seem to start the conversation saying that your views were justified by gold's price. Why isn't Bitcoin's views justified by Bitcoin's price?
If you're going to say, well, Bitcoin is beating gold, so you should buy Bitcoin, Bitcoin is beating stocks, it's beating real estate, it's beating everything. So by that argument, just put all your money in Bitcoin. Bitcoin and gold have nothing in common. Gold is an actual asset, a metal, a valuable precious metal that has all sorts of uses. Bitcoin is nothing. It's just a digital string of numbers. But sure, as long as people want to buy it, the price can go up. But eventually, people are going to want to sell it, and the price is going to collapse.
How do you know that, Peter? Hedge. How do I know you won't eventually sell gold? How do I know if I buy gold? Peter
Well, how
Schiff's
much
not
money
going to
do you
dump a
have in
bunch of gold
Bitcoin?
on my head.
Now, gold is a real commodity. Gold is used in all sorts of things. You can't make Bitcoin without gold. The Bitcoin miners use gold to create Bitcoin. But Bitcoin doesn't have any actual value. But I mean, do you own a lot of Bitcoin?
That's funny. I'm probably the biggest Bitcoin cynic around.
All right. Well, then, so I mean, then stop arguing.
Well, that's doing my
If you think
job.
it's so great, buy it.
I'm just trying to do my job because I'm trying to figure out what's the big separation. Is it almost because if a younger generation has their choice of a so-called store of value, as they call it, and I'm with you there, where it hasn't added up that way mathematically, the way it trades next to stocks and all these things. But ultimately, if there's a group of people that say, I want to own something for the same reasons that Peter Schiff just outlined, because they're the same reasons, and this is their choice of thing, how is it any different than gold?
It's very different. First of all, young people are young, so they make foolish mistakes. They're supposed to listen to older people that
When did
have
you
more
start
wisdom,
getting
that
into
been
gold,
around.
Peter? How old were you?
Well, I actually got my
20s?
first gold, when I was 13. I took my bar mitzvah money, and
Sounds like
and,
you
and then I
you're in the
sold it
same
at a
camp.
big profit, and I bought a car. I got out, and I used it to buy a car. I tripled my money or so in my gold back then.
Where are you at with gold now, Peter? Do you mind me
there-
asking? I asked Kathy Wood how much Bitcoin she owns. Can you give me an idea how much gold you own?
Well, I own a lot of gold, and I own even more gold mining stocks. I have a lot. I have a lot of money in
Dollar,
in that
number-wise?
sector.
Can you give me a range, a figure?
Tens of millions of dollars.
And how much as a percent of your net worth is gold related?
Well, I would say that it's a decent percentage because I have a gold business, Schiff Gold, right? So what's that business worth? That throws off a lot of income. You could try to figure out what the value. I also run a gold fund with several $100 million of customer funds. And I manage a lot of other funds besides the Euro Pacific Gold Fund that still have some gold allocation. So I would say, apart from the money I have invested, I mean, I have over 100 million. I won't say how much, but I'm sure I have over that much in gold.
In gold.
Right? So I don't have $1 billion worth of gold yet in gold-related investments. I think I will. I think in a few years from now, I may have that much just in gold.
Okay.
But your basic question is the difference between gold and Bitcoin. Gold is a real thing. Look, hey, I got a gold watch on. I don't know if you can see that.
I can
but
see.
you
That's
can't
nice.
make that out of Bitcoin. I got a gold ring on my finger. In fact, this was my father's ring. So this has been in my family for a while. It's
This
like
would
an
be the part
heirloom.
where the crypto people would hold up their NFTs and they'd say, I've got an NFT.
The NFT is not is nothing. But Bitcoin is not used for anything. Bitcoin, you buy Bitcoin because you think somebody else will buy it at a higher price. It's called the greater fool theory. It's funny because this is basically a chain letter, but on the blockchain. So it's a blockchain letter.
Yeah.
It's a Ponzi. It's a pyramid. We've done this. They've had these kind of schemes, for hundreds of years.
And I've noticed some of the gold community has latched onto that because now there's like gold on the blockchain.
Well, that's different.
Seems like they've
Because
found
if
something
you
useful in their
tokenize-
technology.
When I send somebody Bitcoin, I'm not sending them money, I'm sending them Bitcoin.
Right.
Now, they could sell the Bitcoin to somebody else and get money if somebody wants to buy it, but I'm not sending them actual money. But if you tokenize gold, I can send you ownership of my gold through a blockchain, and now you own that gold. So that's real. So when you send Bitcoin, you send nothing. People don't understand the difference between the two. Like they say Bitcoin is a store of value, but it doesn't have any value. You can't store what you don't have. The reason gold is a store of value is I can take the gold that I have, and in 100 years, I can make a watch with it. I can conduct electricity with it, right?
Yeah.
I can use it in medicine, in dentistry. Gold has a real purpose in the world. It is a commodity that is used throughout industry. Obviously, the biggest use is jewelry, but it's not the only use. But
Fair
I don't
enough.
see people, not wanting jewelry in the future. I mean, people have been wearing jewelry for thousands of years. I don't think that's going to stop. The people who are going to get killed are these hodlers, the people who never sell, who are just diehard fanatics. I'm taking my Bitcoin to the grave.
Will you ever sell
gold? Yeah, they will, because they'll be worthless.
Are you going to take your gold to the grave, Peter? Or are you going to ever sell it?
Well, I mean, I'll leave it to my kids, right? But my gold has actual value. If I need it, I can sell.
But you're a gold hodler, basically, right? Fair to say?
Well, I'm planning. Most of my gold now is in my mining stocks. And I think they're going to go up 10x at least. And then I do plan on selling.
Okay. Peter, we spoke on December 22nd. You told me that the Bitcoin bubble had popped. We're not going to come back, even if the Fed does cut a few times. So, I mean, is something, obviously we're back. I mean, we made a high. So is there something in your framework that's wrong?
No, I'm not wrong yet. Because the high in Bitcoin, priced in real money, priced in gold, was in 2021.
Well, I could price it in cows. It's something different. I could price it. I change the denominator to whatever I want. Who says gold is the true denominator?
Bitcoin is still about 20% below its peak from 2021 if you price it in gold.
If you price it in gold. Fair enough. Okay.
I would say.
All right. That's kind of like using the word in its own definition, though.
Well, we've had a lot of inflation. That's the problem. So the dollar's gone down, the euro's gone down. Gold reflects that. But look, I think Bitcoin's going to collapse. All this pie in the sky. The last run was created by these ETFs that were launched. And a lot of retail money got sucked into these. There was a big promotion by the promoters of these ETFs, the firms that own them, and charge the fees and make all the money. In fact, a lot of the money that went into the Bitcoin ETFs came out of the gold ETF, came out of gold stocks. That's why GLD was getting net liquidations the whole time gold was rising. We've never seen that. Normally, the public buys the rallies. This time, they sold the rally, and they sold off gold stocks. Gold stocks were making 52-week lows a month ago.
True.
Now they're all like 30% higher. But the public was dumping their gold stocks to put their money into these ETFs. But the problem is, when the people who bought these ETFs want to get out, it will be impossible. There will be no buying in the physical or the spot Bitcoin market. There was plenty of Bitcoin to fill up the ETFs. There won't be enough demand for the people who bought to get out. The price is going to crash. We're going to see the biggest Bitcoin crash we've ever seen, because the guys that are in these ETFs, these are not the long-term, hodlers, the fanatics. These are paper hands.
Sure,
they're not diamond hands. These are traders.
They've got different expectations, ETF buyers.
They're going to get out.
Yeah, I hear you on that. Look, I hear you. If the halving doesn't lead to a huge move in price, then the Bitcoin miners are going to be in a whole lot of trouble.
The halving is already discounted.
I hear you. I hear you. We're
everybody knows about the halving.
This is the choir. We're talking to each other here on those points. Hey, Peter, before...
The real supply, the thing with Bitcoin, the supply is not the new mining.
Right.
Most of the Bitcoin is already here. I mean, there's like over 19 million of them.
Yeah.
So the new supply doesn't matter. What matters is the existing supply, and do people want to hold on to it, or do they want to sell?
No, I agree.
And demand is more important. Is the demand going to go away?
For sure.
Because if demand goes away, the price crashes.
I hear you.
And the demand is all a function of speculation.
Fair point. I don't disagree. Peter, before I let you go, and I appreciate your time to come back to the macro points. A lot of that kind of doomy, depressing stuff that you told us at the top of the interview is going to happen. Can you give me like a threshold of what we should look for? Yeah. If the Fed doesn't cut, because you say if they don't cut, we're going to be in trouble. If they don't cut by when does that next big domino fall in your mind?
Well, cutting is a mistake, but they're going to do it. Look, it started with Greenspan, really, in the 1990s. His cheap money policy inflated the dot-com bubble. That popped. He made the mistake of lowering rates to 1%. That inflated the housing bubble. That popped. They made even bigger mistakes, with the financial crisis. They kept rates at zero for, 12 years or so. And during that time, government spending went off the charts, the deficits exploded, and we've just been kicking the can down the road. Instead of facing the music and cleaning up our act, we just swept the problems under the rug and kicked the can down the road. Well, at this point, there's no more road. We can't kick the can. The problems are just enormous, and we're about to pay the piper, and it's a huge bill. And the way it's going to be paid is with inflation, with a dollar collapse, And so people are going to be impoverished by this. The massive losses spread out among the population. But if you want to avoid that, what I've done, what I'm doing with my clients, I own foreign assets. I own good quality foreign stocks, dividend-paying stocks in countries that aren't all screwed up. And I own a lot of resources. I own a lot of energy. I own a lot of agriculture.
Peter, you still haven't given me a
metal.
country. You keep saying other countries. What's the country that's better than the U.S.? You keep saying that. Who's doing better?
Look, most of the emerging market countries. Look, if you want a big country like Switzerland or Singapore, they're way better as far as their fiscal situation, their regulatory, their inflation, their monetary policy.
You're in Puerto Rico.
We have
U.S. territory.
We have a $1 trillion a year trade deficit with the rest of the world. That means the rest of the world is producing the stuff that we can't produce.
Sounds like a pretty good deal. I like when people bring me things. I like when people bring me things. I like to be a consumer, Peter. I don't need to produce my own stuff.
Yeah, but they're not going to do that anymore because you're not going to be able to pay because they're not going to want your dollars anymore.
When's that dollar collapse, Peter? Since I've known you, you've been telling me the dollar's going to collapse. When's it coming, Peter? When's that dollar collapse coming? You've been telling me that for years.
And look, I don't know the exact date. If I knew for sure,
How would you define it at least? What would be a dollar collapse in your mind, Peter?
But look, 2003 and 4 and 5 and 6, and I kept warning about the mistakes the Fed was making and the housing bubble and the financial crisis that was going to hit when the bubble popped. People would say, well, when? Well, I don't have a date. I just know that it's going to happen. I can't tell you exactly when. It's the same thing now. But a lot of things have happened now, just like they did in 2007, that indicated that the day of reckoning was getting closer. And of course, it happened in the summer of 2008. So I think we're very close to this. And gold's record high is a warning bell that is falling on deaf ears. So I think we're getting very close to the end game. So, you don't want to play around. You want to buy the gold that you need, buy the silver, which is still, I think, a huge bargain. It won't be much longer. I think the price could head up almost exponentially quickly.
Gold.
So people should be buying the metals. And if you got a portfolio of U.S. stocks and bonds, you got to change that. You got to get into the right international assets, good companies at low PEs with high dividends. You got to collect 6, 7, 8, 9% dividend yields. You got to own businesses that sell products and services that people need that they're going to buy, even if the price goes up. And so we've got great portfolios. My mutual funds are available on your platform, no load. You can buy all my funds, the Euro-Pacific International Value Fund, the Dividend Payers Fund, my Emerging Market Fund, my Gold Fund, my Foreign Bond Fund. All those funds, you can get them no load on the Schwab platform.
No Bitcoin in that portfolio. You don't own a single crypto. You don't own a dime of crypto, Peter?
No, look, if you want to go in Bitcoin, take the money that you would have used to buy lottery tickets, or if you're planning a trip to Vegas, instead of, playing craps or roulette, you can gamble with Bitcoin. But don't confuse it with an investment. It's not even a legitimate speculation. It's just pure gambling. It's got no place in an investment portfolio.
You mentioned the International Value Fund, EPIVX, the A-shares, EPDPX for the Dividend Income Fund. Start typing EP and you'll find the funds. Peter, thank you very much for your time. Fun chat.
All right, my pleasure.
All right, thank you very much, Peter Schiff, Chief Economist and Global Strategist at Euro-Pacific Asset Management. And thanks for tuning in to Market Overtime. Thanks, Peter, for your time. You can find all of our episodes on schwabnetwork.com. I'm Oliver Renick. Thanks for tuning in. You're watching the Schwab Network.